3, 2, 1.
All right.
Welcome to the show, everybody. It's Sunday.
December 8th.
Hopefully, we're recording this Friday morning. Hopefully tonight Army beats the heck out of whoever they're playing. It's the championships.
Is it?
I have to look it up. I should know, but
I saw something yesterday. They were playing somebody in Texas yesterday, I thought, and they definitely won.
Games tonight. Tulane, yeah. I couldn't think. I was like
Tulane, that'll be a good game.
I was like, it's not. It's the ACC championship.
It's supposed to be Army-Navy for the championship. Didn't quite work out that way.
Sorry, buddy. Not happening.
Well, we'll see what happens next weekend at the Army-Navy game.
Yeah.
That's the only game that matters, as we all know.
Yeah, no. Well, if Army can do anything besides just, let their quarterback score, it's not a very good tactic in my mind, but whatever gets it done, I guess. Anyway, that has nothing to do with TSP, but
no.
If you're a military football fan, you're
it's a big week coming up this weekend, next week.
Yeah. What you got
Awesome.
for TSP?
It was an interesting week on the market. Anybody who's following Bitcoin, I don't have a chart of it. I'm probably going to do it in the newsletter, but Wednesday night, Bitcoin went over $100,000 a coin for the first time. And, of course, it blew up the financial news media for a while. And then Thursday, yeah, that was Wednesday night. So Thursday, before the open, it spiked up to like 104,000. And then intraday on Thursday came all the way back down to 91,000 and closed like in the middle of the day's trading range. So as often happens, the market makers run it up, take out all the longs, run it back down, or vice versa, run it down, take out all the longs, run it back up, take out all the shorts, and put you back in. They took a bunch of money out of the market that day if you had your stops in place.
Is BTC what you're using for Bitcoin or Bitcoin US dollar?
Bitcoin /US, BTC/USD.
Yeah, that's what I thought.
Yeah.
The only reason I wanted to make sure is if we're talking about the same chart, because I noticed this the other day. I mean, this is the classic problem that I think happens with just about every investment like this. We say it's volatile, and it is. It can be very volatile, but after watching what happens and you zoom back, it's a sideways movement, right?
Yeah.
It kind of does this thing where it goes in these sort of a step pattern. I got the wrong camera on. There we go. If you guys take a look at this, you'll see what I'm saying. We don't have the chart. Sorry, but it's not a Bitcoin podcast, but it's a good learning tool to go look at that, because I watched this about Bitcoin, and a lot of other ones do this. There's this line, and then it kind of shifts, and it goes again, and it shifts, and it goes again, and it's great if you can catch those ups. If you're sitting there in that line, and that it's called a range-bound market because it's in a range, and it's sideways, and it's the hardest thing in the world to play with as an investor, even a smart investor. And what happens though is it ends up just infuriating you if you're like, you don't know what it's doing. Yeah. So you're watching this kind of bang, 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 and you're like, oh my God, it's over 100,000. Oh my God, it's back down to 91,000. Yep. And when you put that in perspective, it's not 70,000.
No.
It's not 50,000.
It's not rolling over.
Right. So that's the part that, the media just loves to talk about it. First of all, the fact that it broke 100,000, I don't. If that surprises you, you're not really actually researching Bitcoin. Yeah. You know what I mean? I don't know what the top is. I don't know. Nobody knows. Yep. All I know is it's going to get more scarce.
Yep.
And that should, big quotation marks, that should drive the price up. The whole point behind Bitcoin versus some of the other ones is that there is a scarcity. It will stop, at some point they'll stop making them. Yeah. Now that's like 50 or 100 years from now or whatever. We won't see that. But if you can imagine 100,000, you can probably imagine 200,000.
Yeah, I mean, I've heard some crazy Bitcoin at $1 million.
Yeah.
I also saw a guy last night that is an analyst that I follow really closely. He's bullish Bitcoin, but he has a potential of Bitcoin coming back down to 15,000 before it gets to 250.
Yeah, absolutely. Well, any of that's possible because of varying things happening that you can't control, policy changes, legal challenges, like all kinds of crazy stuff, right?
Well, like in that case, the way that happens is there are so many people that have so much money in Bitcoin right now. If you bought Bitcoin and held it over the last couple of years, that's a huge reserve on the side that you have.
And at some point, you might want that money.
Or you might need to use it.
Yeah, that's what I mean. You might need to use it.
Right. So,
Yeah.
but that what I'm saying is, if you have if you look at a chart of the Nasdaq and track it to Bitcoin, when Nasdaq tanks, Bitcoin tanks.
Yeah.
Like it's correlated
To a lot of tech.
Yeah. And if we have a big collapse in the stock market, people sell everything because you have to sell and then it starts falling and everything falls.
If you need the cash, you're going to sell it.
Yeah.
You know, if you're a disciplined person, I saw a kind of scenario the other day where a person bought 100 Bitcoin back when it was $12, or something like that. It was 2012. It's not that long ago.
No, it's not that long ago.
From perspective. And, you know, that's like $1 million now, you know. Now, if that person is disciplined, they didn't need that $100 that they put in.
Right.
Hopefully they're doing other things and they don't need that, right? Because that million someday will most certainly be 100 million. Like at some point.
At some point, yeah.
So as long as you don't need it, but yeah, as soon as they start selling, and honestly, that's what I think the smart non-institutional investors should be watching. You know, I look at this sort of stuff two ways as a kind of a smart investment. One is it's not really dollar cost averaging. It's just the fact that I got an extra $100 a month that I'm just going to buy Bitcoin with.
I do. I dollar cost average
Just
$100 a month into Bitcoin.
Put it in there, right? Just let it ride.
It just goes into a wallet.
Let it ride. Now, and that's generally what I do, right? Because I'm not gonna put a huge amount of money in there, but that someday that could be a huge amount of money. You don't know. There's that way, or you play the Warren Buffett role, and you sit back, and you keep yourself a good chunk of cash. Let's just say it's 10 grand, right? You get yourself 10 grand, and you wait till that crash does happen.
Yep.
And at some point, it will happen because it's the volatility of the market. It is the thing. It's going to happen. I don't know if it's going to happen 10 years from now. Who knows what it's going to go down to? All I'm saying is hold that. And when that happens, you go in and buy, and then you let it ride it back up to 100,000. And how much money are you going to have? You know, that's probably the best two ways to play it. Everybody wants to play it like day trading, and if you got time to day trade, great, go for it. And you got the education and the knowledge and all that. But that's the two best ways I think to play crypto as a currency. I mean, how many U.S. dollars are there? I don't even know. Like how many?
Oh, we can print as many as we want.
I know, but let's just like out there right now, trillions, right?
Yeah.
So to say that Bitcoin wouldn't go to 1 million is like absurd. Of course it can. We're in the trillions with other currencies.
Yeah.
To say that
it all becomes theoretical.
Exactly.
Actually, it's not real.
Yeah, exactly. Yeah. So anyway, we're probably talking way too much about Bitcoin on a TSP podcast, but
that's actually the mentality of fundamental investing, like Buffett does. I mean, he doesn't do Bitcoin at all, but
he just doesn't understand it,
right?
Not because it's not a good thing.
Yeah. No,
he says that, right? He's like, I don't know anything about it. I'm not investing in it.
Right.
You know?
But like we talked about the last week, the week before, he's over 50% in cash right now. And it's not because he necessarily thinks the market's going to crash. That a lot of people make that kind of connection. He's a value investor, and he doesn't see anything that is undervalued. Right. So he doesn't, and things that are overvalued, he sells. So as they get overvalued, his cash position increases. He doesn't have any place to put the money, so it's in cash. That's all it is.
Yep. He's just waiting for the next, undervalued company. That's a big company that's going to get all his little tick marks.
Right.
And they're going to happen.
The fact that there aren't any now, valuation is earnings per share price, right? So either earnings of these companies catch up to the share price, which makes it a value play for him, so now we can buy the company, or the price of the shares come down, which is a market crash, right? So if either one of those happens, it's just really hard, especially when you're in a bull market like this, because as earnings go up, the price goes up more than earnings go up.
Yeah.
Right? So
it's like a perpetuating cycle.
Yeah.
It's crazy time. Yeah. It's crazy time for sure.
It's actually a pretty good lead into what we got going on.
Good. That's what I was trying to do.
Yeah. So there's going to be some conflicting data here throughout this. But the overriding idea behind this week's podcast is it's almost a carry on to what we did the other day in the Facebook Live group. There's some really smart people out there, and some of them do really well at these market tops. Not to say that we're at a top necessarily right now, but some of them get clobbered. So here we go. We'll look at what happened this week, and then take a little walk through history of a couple of examples of the smartest people and the biggest bubbles. And then we'll take a look at 2021. There's a lot of comparison right now between the end of 21 and the end of 24. And does it look like, does 21 look like 24 so that, 22 is a bear market, is 25 going to be a bear market? We'll see in that TSP fund charts. So Monday we had manufacturing PMI increases to 49.7 from 48.5, which is good, right? It's a big tick up. It's still below 50, but it's a big improvement. S&P is up 0.25% on Monday. The manufacturing PMI means to increase means that manufacturing is getting better, right? So we're in this uptrend, at least for the past 3 months. Anything below 50 is contracting. So you definitely want to be above the 50 line. And we're not quite there yet, because it does, by the definition, technically, as long as manufacturing is below that 50 level, the economy is still contracting, but it's improving, right, for the past 3 months. JOLTS came out on Tuesday, job opening labor turnover survey increased to 7.7 million from 7.3 in September. So the labor market's getting stronger, right? That's good. S&P's basically flat, was up a little bit, 0.05%. Wednesday, this was the first big, I'll say big, decrease in the 30-year mortgage rate in a while. It's been going up, and you can correlate that absolutely to the F fund, right? The F fund had been going down for quite a while, really since the Fed started its rate cutting cycle in September. The F fund had been going down. 30-year mortgage rates have been going up. And then this week, the mortgage rate fell from 8.6% from 6.86% to 6.69%, which is a pretty big interest rate move down, but it's also corresponding to the F fund having gone up for the past couple of weeks, right? Because when rates go down, the price of bonds goes up, so the F fund goes up. New mortgage applications, on the other hand, jumped to 2.9% from 6.3% last week. I think that's the wrong way around. Jumped to 6.3 from 2.9. S&P is up 0.6. Also Wednesday night, we just talked about Bitcoin passed 100,000 for the first time. That was big news. Thursday, initial jobless claims rose to 224,000 from 213,000 last week and 214,000 forecast. So initial jobless claims goes up, right? S&P was down about 0.2%. And then conflicting again on Friday, non-farm payrolls goes up 227,000 jobs, which is more than the 194,000 forecast, right? So we have more people being employed, which is good, more than forecast, but the unemployment rate ticks up from 4.1 to 4.2%. And then at least at the open on Friday morning, the S&P is up about 0.25%. But the unemployment rate is an important one, okay? This is the unemployment rate, and it's a monthly scale. So this is a 20-month moving average line in black, okay? So you can go back as far as you want. I went back to 1972, basically. The thing is this. When the unemployment rate gets below the 20-week or 20-month moving average line of the unemployment rate, the market is doing good, okay? When it ticks back above, when unemployment gets above that moving average line, it tends to accelerate up. And unemployment is bad for the economy and bad for the market. And the problem is that no matter how far back you go, every time it gets above that line, right, every time it accelerates to the upside. It never gets above there and then reverses, right? And it tends to go for years. It increases for years. So where we are right now, this chart hadn't updated, so it's got us at 4.1. It actually went up to 4.2. So as far back in history as you want to go, suggests that unemployment rate is going to go higher from here for some amount of time. And here is the top in the stock market in 2000 when unemployment gets above, right? The market had already rolled over at that point. It was basically at the same time here in 98 when the great financial crisis, and then COVID is pretty much a one-off because we fired everybody, so that doesn't really count. But no matter how far back you go, when we get above that 20-month moving average line, unemployment goes to the upside. And so we've been talking about it here for a couple of months. As if unemployment is probably the biggest thing to watch in terms of macro stuff, because if unemployment keeps ticking up, the market rolls over. It's just the way it goes. Okay, smartest people and the biggest bubbles. So Isaac Newton, not necessarily a financial guy, but pretty smart guy, right? Was one of the many who lost their entire fortune in the Celsius bubble in the 1700s. Okay, he invested early, sold high, and made a good return on his money. But he also suffered from FOMO as he watched his friends continue to invest and make even more money. So he bought back all the stock that he had sold, plus a lot more, and he borrowed a bunch of money on the second time he was getting in, right? When prices crashed and the stock became worthless, he lost money, supposedly said, "I can calculate the motion of heavenly bodies, but not the madness of people." That's what it looked like. Okay, so Newton gets in a little bit. He sees the uptick, and he buys. He makes so he gets in here at 150, and he gets out here at 350. He did pretty good, right? But then he saw all his friends getting rich up here, and he's not too happy about that. And they keep getting rich, so he gets back in. And he makes a little bit, right? And the market rolls over, and he's like, it'll come back. It'll come back. He's listening to his friends. It'll come back. It gets down. He loses a lot, gets out a little bit more. Finally, we're almost at the bottom. He says, forget it. I'm completely out. Arguably one of the smartest guys that ever lived on the planet. And there you go.
You didn't watch our podcast.
The thing that I like about what we do is that, we're in the stock market, right? We're 50C, 50S. And we're looking at the indicators that will tell us when it's time to get out. And we talk to our friends. Like, we have friends that are Bitcoin bulls and stock market bulls, and they're like, the market always goes up, and what are you guys even talking about? You have to hold both things in your mind at the same time. You have to hold the idea that the market can keep going up, and it's not going to go up forever.
Well, that's because that's just facts.
Yeah, it shouldn't be a surprise to anybody.
That's just facts.
So keep the shape of this chart in mind as we keep going forward, right? In 1929, I didn't bring the book. I was going to bring the book in here as a prop. 1929 crash was a defining moment for Benjamin Graham. So Benjamin Graham, he wrote The Intelligent Investor, like it's the Bible of value investing. He was Warren Buffett's mentor. Okay. So his brief track record before the crash earned 25% returns for his clients, which is great. Beating the Dow Jones Industrial Average was the thing back then. There wasn't an S&P 500. So beating the Dow by 5%, but leverage got the best of him in 1929. So the idea that Benjamin Graham was using leverage is interesting because he lost so much money in 1929 to 1932 that he completely changed his whole investing philosophy to being a value investor, which is what everybody knows him for now. But he did it because he lost a truckload of money in 1929. So he lost 70% from 29 to 32 versus the Dow's 80% loss. Okay, so he was actually he beat the market, but he was down. His clients lost 70% rather than 80%. It also meant he went unpaid for the period. His fee structure was set up so that he only got paid if his clients made money. To supplement his lack of income, he wrote this book called Security Analysis, which is the second most famous book that he's written. First book to lay out a framework for sound investing, because he went back and looked at what he did over the previous couple of years and wrote a book about sound investing. Graham made his clients whole by 1935, okay, but he emerged from the crash a much more conservative investor. He swore off leverage and made risk/losing money his top priority, which is where a lot of these rules come from. The number one rule is don't lose money. Hopefully, we were talking about yesterday, hopefully you don't have to, you can learn from people and not have to experience it yourself. There are plenty of people around, we talk about it all the time, plenty of people around in 2000 that lost half or more of their TSP. And I guarantee you those people are looking at the market today a lot different than people are that are, have only been in the government since like 2009, let's say, or later.
Yeah, it's also key to remember so there's two pieces to this. One is where you pay attention to what other people did so you don't make the same mistake, right?
Yeah.
Good strategy. The other piece is pay attention to what you do that doesn't work. So you have to be self-reflective as you're gaining your investment knowledge and skills, right, and experience. So if you did something last year and it seemed to work, right, build on that. If you did some things last year that didn't work, build on that, right? Get more educated, read more books, look at scenarios like this. I mean, that's very much what Ray Dalio did to be who he is today, which is one of the, there's all these accolades for how great of a fund manager he is. But early on in his life, he did the same kind of thing that Newton did. He got in, he crashed and lost all his money, and he's like, okay, well, that was stupid. I didn't know what I was doing. And so, he found his system, his process, his thing, and that's really, I think, what the most important things. That's what people miss is they want someone to give them a pre-made plan that works for them.
Every time.
You just tell me what to do.
Yeah.
Okay, that may work.
The whole system sells it to you. It's called a 401k and an IRA,
and it may work for you. And for some people it does, and that's fine. But if you truly want to take control of it yourself and you want to do it, you have to put in the work. You have to put in the time, and you have to learn. And you're going to learn from your mistakes. And so there's two pieces. One is looking outward, and that's looking at what other people are doing and the mistakes they're making and learning from that. The other one is to look inward and say, okay, what am I doing? Am I not reading analysis each week to see what the market is doing? Am I just going to Bloomberg and hoping to get some little bits and pieces to figure it out? All that. Like you have to. Well, we say it all the time. The most important thing you can do to manage your TSP account is to make a plan. Stick to the plan, revise the plan, stick to the plan, revise the plan. You know what I mean? Just do that cycle. People in the government and the military should understand that better than anyone else. It's literally like if you're in the military, it's called the military decision-making process. They have an acronym for it, right? Yeah. In the federal government, we have very similar things, right? You have to build a plan, execute it, revise that, execute it. That's the same way we're doing here. Yep. And so that's how these good investors became great investors. Yep. That's it.
And honestly, a lot of them quit. Or most of them quit, right? Most of them they blow up and they quit. That's why the hedge funds keep rolling over every year. You don't usually see the same hedge fund around 2, 3, 5 years in a row.
No, it'll work for a while, and then their system breaks.
Yep.
And they're not willing to figure out another system, so they just punt and run. And unfortunately, the fund manager is the one making the money.
Oh yeah,
that's the kicker. That hit me when I looked at all this Forbes list years ago, and I was like, why are all these fund managers on it? They shouldn't be rich. It's the rich people they're getting the money from. Like, oh no, they figured it out. Yep. They're getting paid no matter what happens.
No matter what.
They're getting their 2 and 20 no matter what.
Yeah. I mean, honestly, nobody's happy with Benjamin Graham when he has you down 70%. But if you look at the overall market and it's down 80%, if you want to be really optimistic, you can say, well, I beat the market.
But you're still down 70%, but you beat the market.
Yeah. I mean, I have a good friend that was doing this kind of stuff in it was 2000 or 2007, and he was down like 25% when the market was down 50%, which is hard to do. And he went out of business because people don't look at it that way. They're like, you lost me 25%. Anyway, so finishing up with Graham here, he says, not long ago I was told of a counsel being given by a large Wall Street banking firm to the effect that an investor is foolish to own any bonds at all. since all he can expect from them is a decrease in the value by reason of inflation. How many times do we hear about that? Don't go to the G fund because it's not going to beat inflation. This may seem like good advice to those familiar only with the history of the past 12 years, and ironically, that's pretty close to where we're at now. But to one like myself who has experienced personally the ups and downs of the past 47 years and has studied those of many decades previously, this counsel seems to be short-sighted and rash. My motto would be taken from my favorite poet, Virgil, who has only 3 words, I can't read them in Latin, ready for either event, which is the foundation of what we're trying to do here. You got to be able to hold both things in your mind. The market's going up, and it's not going to go up forever. This is what it looked like in 1929, right? So here's 1929. Here's the top. And the only reason I put this up here is because it took until 1954 to get back to even. So if you had $1 million in your TSP in 1929 and you were planning on living on it, first of all, you lost 80%. So you would have to go back to work or whatever you'd have to do. But if you did hold it, you were finally back to even 39, 49, 50, 30, 25 years later, more or less. All right, fast forward to like the current day. We're at the top in 2000, and Jim Cramer is doing jumping jacks on Mad Money. He experienced significant financial fluctuations during the dot-com bust of 2000 2003. At the peak, his net worth was notably higher, due mostly to his 15% stake in his company that was called TheStreet.com back at the time. So in 99, TheStreet.com had a market cap of $1.7 billion. So Kramer's 15% stake was about $255 million. So let's just say his total net worth is $255 million at the top. Following the dot-com bubble, the value of his holdings declined substantially. By 2005, it's somewhere between 50 and 100 million. So if let's give him the high side, 100 million, that's, 60% loss. If it's 50 million, it's like a 75% loss. The decrease was primarily due to the significant drop in the value of the Street.com and other tech-related investments. That's what that looked like. This is the NASDAQ. Okay, so the first chart, I don't know what it was. It was back in 17, whatever, so I'm not even sure what they used. The 29 crash was the Dow Jones Industrial Average. This is the NASDAQ, right? This is the tech collapse. It was down 83% from the top in 2000 to the bottom in 2002. And so if you were holding the NASDAQ, it took you until 2016, so almost 17 years to get back to even. And then the last one is the Great Financial Crisis. So Stanley Druckenmiller, we've talked about him before. He's on podcasts quite a bit. One of the best hedge fund guys ever. He used to run George Soros's fund, and now he runs. He ran Duquesne Capital Management back in 2000. Now he runs this family office. It's Duquesne. It's a family office. So Druckenmiller, hedge fund Duquesne Capital Management at the time, achieved an average annual rate of return of 30%. Average annual rate of return of 30% from 1986 to 2010, consistently outperforming the broader market. That is outrageous. 30% on average every year from 1986 to 2010. I mean, that's unbelievable. During the Great Financial Crisis from 07 to 08, Duquesne Capital not only avoided losses, but also posted a modest gain of approximately 3% in 2008. So the market's down 55%. He's up 3%. That's more impressive than making 30% from 86 to 2010. But it probably didn't beat the G fund. And he was working his butt off to make 3% while the market's crashing in the Great Financial Crisis. This performance is attributed to Druckenmiller's strategic decision to maintain a significant portion of the portfolio in cash, providing flexibility to navigate the market turmoil effectively. Exactly what you were talking about before, which is obviously what Warren Buffett is doing right now. And that's what the Great Financial Crisis looked like. This is the most current one, right? Most recent in time anyway. It is the top in 2007, and you're down 55% by March 2009, and it takes until 2013. So whatever, 7 or 8 years to get back to even. All right. So we're not saying that we're at a top. We're saying the smartest guys in the world, some of them can navigate this thing, or we're able to. Some of the best financial guys couldn't, and some of the smartest guys in the world, Newton, got hung up in FOMO. So you just have to be able to hold both things in your mind at the same time. So 2021 to 2024, we talk about JC Peretz all the time, right? And here's a kind of a good example of you. You can see, you look at this chart, right? When he put this out on a recent newsletter, and he's very bullish, right? So his come from right now is he's really bullish on the market. AAII is the association of like average investors, something like that. It's basically some people would call it the dumb money. Okay, some people it's individual investors. Okay, it's not like corporate commercial people. It's individual investors. So JC is saying the idea of market sentiment, when there are more bears than bulls, it means people are nervous. They think the top is in, and the market's about to roll over. And when enough people, when the sentiment is bad, right? There are more bears than bulls. The market tends to go higher, right? It feeds off that, because when you're at major tops, everybody's a bull, right? Everybody thinks that the market's only going to go higher. So that's when it tends to top out. So when you have more bears than bulls, he's saying that's a positive for the market. And a lot of times that's true. So he's looking at this chart. He put this chart out to show that we're not at a top yet because there are more bears than bulls. And this line needs to be up here somewhere before there's irrational exuberance and the market's at a top. Okay. But what if you looked at it the other way? What if you looked at it and said, okay, you're just barely below that line here. You were also just barely below that line here and here, right? At the top in 2021, right? That was that high and then the final high, but the trend had already been coming down. So, can you say this trend is coming down, and is it similar enough to that? You can definitely look at this chart from a bearish perspective and a bullish perspective. So the best way to look at it is from both ways. Because if you buy into this, the way he presents it, he's not presenting a bearish case, he's presenting a bullish case. And if you only have that idea, and the market rolls over, this line is going to keep going down. Just like this. So it'll be interesting to see how that plays out. And I don't know which way the market's going to go, but JC thinks it goes up from here. It very well may. Who knows? This is what it actually looks like. Here was the bottom from COVID. It's a weekly chart. The only thing I really wanted to point out is relative strength. Relative strength is a really important one in MACD. So on MACD, you can see when we start coming off a bottom, you start to get momentum that's really high. So when we come off these bottoms, right, momentum picks up a lot. And then as price continues to go higher, momentum starts to wane, right? The line starts to flatten out. So this like period right here is kind of flat, right? And it's the topping in 2021. Right now, we're still expanding in MACD. That's a really positive sign, right? We're not even flattening out. Forget rolling over, right? Momentum is expanding to the upside. Not as much as it would, when we're coming out of a bottom, but it's still expanding to the upside, and price is moving higher. So you have to be in the market when the market's expanding to the upside. Relative strength is basically flat at overbought. It's not coming down like this yet. So you can anticipate it all you want, but if you're not in the stock funds, you're going to lose whatever the potential upside is going to be. You just have to keep both things in your mind at the same time. All right, so TSP fund charts. So here we are on the C fund. This is as of the close on Thursday. We're not at a new daily all-time high. We probably will be by the close today, I think, but we're certainly at a new weekly all-time high. You got relative strength continuing to decrease, but it's not rolling over. And you got a really good support level at that 20-week moving average. So until price gets below, I mean, now you got a really good support level right here at 92.50, right? I would say anything below this low right here, we're in trouble. And that's a pretty good percentage move down. But on a weekly basis, until we get below this low, the market's moving higher. S fund, really good breakout finally through that top at 90. That was right there. Huge breakout on election week. Had a little bit of a pullback the week after that. Follow through week there. You know, we're kind of consolidating here. Can we come down and close that gap? Easily could do that. Come down a little bit, close that gap, and keep on moving. It's a really, really strong breakout for the S fund on a weekly basis at this point. I fund we've been talking about for the last couple of weeks. You don't have the I fund coming down, right, and the S fund going up for very long. That divergence doesn't. They both move in the same direction. What's happening?
We lost your computer, so we'll just stare at you for a second. I'll go back to us.
That was weird.
Did we get it?
Yep.
All right.
Okay. So the S fund, I don't know what I touched. S fund going up, I fund going down. Doesn't happen for very long, and we said that divergence is going to go one way or the other, right? Either the S fund is going to, C and S funds are going to pull the I fund higher, or the I fund is going to pull the C and S funds down, and we got a breakout, a new buy trigger, right? We got above that 20-week. This week on the I fund, we got above 50 on RSI, so it certainly looks like the I fund is getting back in gear and following along with the C and the S funds, which now they're all moving in the same direction, which is bullish. I can't remember if we talked about it on the podcast or the newsletter, but we were saying last week this was a really good place if you didn't want to change your allocations. If you were in the C and S, but you wanted to get into the I fund in the mutual fund window, it was a low risk entry point for the I fund. And, you know, this week was it's good. Now we got a buy trigger and it's off to the races for the I fund. Same thing with the F fund. It was definitely hitting that trend line, and the yield had been way overbought, which means the I fund was, or the F fund was oversold, and it was right there at that 50 RSI line and was getting support there for a couple of weeks. So it was a good low risk entry to the F fund or something in the mutual fund window that kind of tracked the F fund. And the G fund continues to go up and to the right, just not very quickly. Questions?
If you have questions, you can always get them to us in the comment section wherever you find the video. That's usually that's the only way we'll see them.
Yep.
If you don't have a comment section, you can email us at support@growmytsp.com, and support team will get it over to us. We like questions, we like comments because it gives us stuff to talk about. So if you guys are enjoying it, share it with your friends. If you're not enjoying it, share it anyway. Hope you guys are getting prepared for the holidays and everybody's got their shopping done.
No, not yet.
All right. We'll see you guys next week.
Later.